It is good that you wear casual, because it is more comfortable when we have a long session similar to today's one. As I promised you in our last session, I will talk today about goodwill as an intangible asset with an indefinite useful life.
It appears that it is a very interesting topic, Dr. Khalid.
Look, you're a fat. Goodwill is recognized only in a business combination. In other words, goodwill is an intangible asset representing the future economic benefits from other assets acquired in a business combination that are not individually identified and separately recognized.
I understand that goodwill is an intangible asset with indefinite useful life, and therefore it must not be amortized. Is this correct?
It is correct. It must not be amortized subsequent to its initial recognition, and is instead tested for impairment.
In which financial statements goodwill is presented?
The parent company presents any goodwill in its consolidated balance sheet as one amount under non-current assets. Note that internally generated goodwill must not be recognized in the financial statements.
How the amount of goodwill can be arrived at for initial recognition?
That is a core question. Because your question is important, please listen to the answer carefully. In a business combination, a parent company may recognize goodwill or gain from a purchase bargain. Recognition of goodwill or gain from a purchase bargain can be determined by comparing between two elements. 1. The sum of the acquisition date fair value of the consideration transferred plus any non-controlling interest plus any previously held equity interest in the acquiree. 2. The acquisition date fair value of identifiable assets acquired and liabilities assumed. In other words, the fair value of the net assets acquired. The rule is as follows. If the amount of 1 above exceeds the amount of 2 above, goodwill is recognized in the parent company's consolidated balance sheet. However, if the amount of 2 above exceeds the amount of 1 above, a gain from a purchase bargain is recognized in the parent company's consolidated income statement.
The rule above needs to be simplified. I appreciate. Would you give me 2 examples, one for goodwill recognition, and the other for gain recognition resulting from a business combination?
That is exactly what I plan to do. Assume that Al-Qawaga Saruf and Benjamin Hanania Company (S&B) acquired 80% of Sosoli Afi and Ephraim Solomon Company (S&D) for $192,000. S&D Company's fair value of identifiable assets and liabilities were $350,000 and $140,000 respectively at the acquisition date. The fair value of non-controlling interest, representing the remaining 20% of interest not acquired by S&B, was $48,000 at the acquisition date. Based on the information given, I want you to determine if there is goodwill or gain from this business combination and in what amount. Do not be afraid to make mistakes.
In following the rule above, I should first calculate 1. The fair value of the acquiree as a whole at the date of acquisition, and calculate 2. The fair value of the net assets acquired at the acquisition date, and then compare between the two of them to determine whether there is a goodwill or gain and in what amount. To calculate the amount of 1 above, I should add the consideration transferred of $192,000 to the fair value non-controlling interest of $48,000 at the acquisition date. Thus, 1, which is the total value of S&D Company at the acquisition date, is $240,000. To calculate the amount of 2 above, I should subtract the fair value of identifiable assets acquired of $350,000 at the acquisition date from the fair value of liabilities assumed of $140,000 at the acquisition date. Thus, 2, which is the fair value of net assets acquired at the acquisition date, is $210,000. Since 1 exceeds 2, goodwill recognized in the parent company's consolidated balance sheet equals to $30,000, being 1 of $240,000 minus 2 of $210,000.
Excellent, you're a fat. Using the information provided in the example above, assume that the fair value of the identifiable assets acquired was $400,000 at the acquisition date instead of $350,000. What will be the results?
1, which is the total fair value of S&D Company at the acquisition date, remains unchanged at $240,000. 2, the fair value of the net assets acquired will be $260,000, being $400,000. The fair value of identifiable assets acquired minus the fair value of liabilities assumed of $140,000 at the acquisition date. Since 2 above exceeds 1 above, A gain from purchase bargain equals to $20,000 should be recognized in the parent company's consolidated income statement.
Excellent, Eurofat. We still need to discuss the impairment test for Goodwill, but I prefer to start with in the next session for the time consideration.
Thank you, Dr. Khalid.